Very good morning to you. I'm Malcolm Graham Wood, and it's a joy to be back here at Core Finance, doing one of my CEO interviews. But today I've upgraded a little bit because I've got Andrew Austin here today, who's chairman of RockRose Energy. Welcome back, Andrew.
Hi, good to see you too, Malcolm.
Nice to see you, and thank you very much for coming in. Busy time. As usual, the first thing I always ask people to do is to give an overview of the company. There will be some people watching who don't know too much about RockRose or looking at it for the first time. I want to hear what you've got to say, but let's have a bit of an overview of what you do.
Sure. RockRose was set up just about 2.5 years ago with the purpose of buying effectively unloved assets in the North Sea and taking advantage of those assets and maximising the value that may be within them. A RockRose is a plant that grows in a hostile environment with minimal external impact. And on the day we floated the company, it was the day that the oil price hit $27. So I think it was appropriate, particularly at that point in time. We're now in a position where we produce around 11,500 barrels a day across the North Sea. We have over 50 million barrels of reserves. We have no debt. And we're non-operated in all the assets we currently own.
Now, before we get into you had a very big year in 2018. Quite a lot of people say to me, exploration companies say we want to buy production, and not many people go the other way around and buy production first. And in fact, you don't have any exploration at all. But they often say that production is very difficult to find. You clearly either haven't found that, or you've been looking in different places.
I think what we've done is we've really specialised in trying to work out our own metrics as to how to value production and our own approaches for purchasing those assets. There are a number of people for various macroeconomic reasons who are seeking to leave the North Sea. Also materiality reasons, that assets no longer are material. We particularly noticed that there's a lot of Japanese companies that have been leaving the North Sea. So we flavoured our offering to make sure that we could respond to the requirements that they had in trying to exit their assets cleanly. We're now seeing other groups, including this well-publicised number of Americans currently leaving the North Sea as well, to sort of go back and just look at shale in the US.
Yeah. So this year, 2018, has been a busy year. As we come to the end of it, why don't you talk me through the highlights, what you've done this year and what you've ended up with now?
Well, it's literally just over a year ago that we completed on the acquisitions of Idemitsu and Sojitz and Edgerton Ventures. That was completed on the 8th of December 2017. So we've now had ownership of those assets for around a year. Through the year, we obviously paid a dividend, had capital redistribution at the beginning of the year of £1.50 to all of our shareholders. Since then, we've also acquired the Dias portfolio in the Netherlands, mixing our balance from oil and gas to roughly 50-50 now between oil and gas. We also secured the Arran, a stake in the Arran development, which we're very excited about. We think under the operatorship of Shell, particularly given their links into Shearwater, that's going to help flatten out RockRose's production profile for the foreseeable future. And we see peak production in the sort of 17,000 barrels a day area, and not coming back below 11,000 until after 2025. So I think a lot of people look at us and think that, they've got a lot of decommissioning liabilities and it's just all going to run out very quickly. 2025 is quite a long way out from now. And that profile actually matches many of the other listed
you won't be surprised. I'll come back to decommissioning in a minute because it's one thing that people all need to go through. But in those ones that you've acquired and so on, I think there are some interesting ones, because I know in DS you said that it's one of the ones where you've got quite decent organic growth opportunities there. You've got some upside in that one.
Sure. Well, we've literally just been drilling a well recently at A18, A5. That's now come on production. There are capacity constraints through the platforms, which mean that it's being choked back. But actually, that helps the overall argument because it just pushes out that plateau longer. And we're also decommissioning at the same time as well. ST1 is being decommissioned right now. We've put some pictures up on Twitter recently about that happening. So We're doing both at the same time.
Yeah.
I mean, the budget for next year for capex is significant. It's going to be in excess of $70 million of capex in the course of next year, out of an EBITDA of around $100 million.
So, and you mentioned Aaron as well. Now that's the first one, and the excitement there was well, obviously Shell as the operator, but that's the first one which isn't actually producing at the moment, isn't it? It's in pre-development.
Well, Aaron and Tain. So Tain is something we acquired through the Idemitsu portfolio. So Tain, we're looking to FDP as soon as possible on that as well. But Aaron, yes, we came in and stood into Dana's shoes on that asset, and we actually felt that the prospect of it becoming the change in operatorship through to Shell, because of their link to the Shearwater platform, because of their experience in long pipelines, actually enhances the proposition that is Aaron. And so we're very happy to have that in the portfolio to help give more longevity to where we stand.
Excellent. Now, while we're on what's happened this year, you made a tender offer for 10% of the shares.
20%.
20% of the shares at quite a high price, given that the shares have been, have been a good runner this year anyway, but still, as I know people think, it's undervalued. So what was the rationale behind that? And you obviously filled the order effectively, but I remember you saying to me, we think our shares are the cheapest in the market. So tell me through the rationale for the deal.
I'd go slightly further than that, Malcy, really. The cheapest thing we could buy in the North Sea right now is ourselves. And we had cash on the balance sheet. We had a lack of liquidity in the shares. There were a number of people who had been investors from the outset who had made quite significant amounts of money, but wanted an out, and so we basically tendered for those shares. And I think actually we got the perfect result at about, I think it was 95% acceptances, because if more people had accepted, then there could have been a perceived overhang, because they could have psychologically, you could have said, well, these people are natural sellers. And if less people had accepted, then So actually, I think it's a perfect scenario.
You pitched it right, but would you do it again? Would you? Or would you buy? I mean, it hasn't narrowed the gap that much between the market price and most people's perceived valuations.
No, it hasn't.
Because a lot of people say to me, this is a company on a P of 1 with no debt, and so the upside should be much more significant. So it hasn't sort of.
Well, I think look, it's made a difference. We were trading, around £5. We've been as high as £7 since it was announced. I think some people have got slightly misled with the TR1s, the statements of positions that have come out afterwards. For instance, I have not sold any shares. Someone came out with a comment the other day saying, well, Andrew Austin's tendered his shares into it. Andrew Austin certainly has not. And
because
he's more likely to be a buyer than a seller.
Well, the small number of shares in issue means that you've now gone up to, what, 28%?
28.3%. So there's 12.56 million shares in issue now. Those have been cancelled. It takes sometimes a little time for the
the registrar.
Some of the data sources like Bloomberg and LSE and the London Stock Exchange to update their numbers. But there is 12 million shares in issue now. So yes, we're again trading below 1 times EBITDA. I think what we've done, and our industry has often had a bad reputation for not for taking money from shareholders and then sitting on it when they've not actually necessarily got anything useful to do with it. And I think what RockRose hopefully has demonstrated is that we will return it to shareholders when appropriate and when we can do so. And so not only when we'll do that in a series of different ways.
Right. Well, you mentioned just a few minutes ago that you've had a special dividend at the beginning of the year. That's the other question that everyone asks at the moment. You paid out the one-off. Does that mean you'll do it again? Is it going to become a regular feature? Will it become an annual dividend payer?
I think we will. We are definitely looking towards regular dividends. That is definitely the way we're going. But we're looking to return capital in any number of ways, including share buybacks. So sometimes we may do it through a share buyback, sometimes we may do it through a dividend. But actually, what we're doing is returning shareholders' money to the shareholders once we've realised value for it.
And just think, when we first talked about that original buyback, and people thought, are they going to be in a position to? And in fact, now you could have done it bigger and again. people talk about operational updates. We've talked about this before. It's not one of those things you sort of plan to do quarterly, I understand, but you will be trying to update the market as often as possible. It's probably not possible to do it when you have so many things on the go.
I mean, that definitely makes it quite complicated because, we're constantly looking at other transactions. We're obviously also developing our existing portfolio. I think quarterly updating on where our cash position is and our production is not necessarily appropriate at this point. Every 6 months is fine. But what we will do is, and we are listening to what people are saying, and we will certainly focus on making sure that the market is kept up to date as much as we practically can.
Excellent. Right. One of the perceived challenges in the business in general is correctly calculating how much you will have to pay for or need for decommissioning, and when that's going to be needed, and how you gear yourselves up for that. Because some people say that, I've heard people say, not just with RockRose, but other people saying some people leave it till nearer the time and when they may not have the production to achieve the cash flow. And I'd like you to explain to people exactly how, within RockRose, how you analyse decommissioning, how you prepare the money and make sure that it's all going to be there when you need it.
Sure. Well, a number of our assets, our UK assets, and from 2019, some of our Dutch assets are subject to what's called decommissioning security agreements. So what that does is it works out, the operator of the asset provides you with a forecast as to what they think the cost of decommissioning will be and what they think the free cash flows that will be received from the assets between now and then are. You take one away from the other, and what you're left with is what you post into a decommissioning security agreement with a risk factor.
Right.
So one can post those monies as a letter of credit. If you have a rated company, you're rated with one of the rating agencies, you can do that with a parental company guarantee, or you can do it with cash. In our case, we currently do it all with cash. So the number that sits on our balance sheet as a restricted cash number is the value today of the cost of decommissioning those assets down the road.
Right.
And it's not RockRose that comes up with that. It's the operator of each asset that comes up with that and feeds that back through to us through the joint venture mechanisms, and then we post those monies. Now, what's tending to happen is decommissioning is being pushed out.
Yeah.
I think something like 80% of our assets now have had, in the time we've owned them, have had decommissioning extended by at least a year. And also it's getting cheaper.
Yeah.
Someone said recently, I wish I could take credit for this quote, but you don't hire an architect to demolish your house. And decommissioning in the North Sea has been something that's been thought of as a very heavy engineering. The same people who built things are looking at demolishing them. That's not necessarily the right constituency to use. And specialist firms, waste firms are coming into that space. The vessels are being built to be able to cope with heavy lifts of topsides and doing things effectively, and those costs are coming down. And I think that provides an opportunity for RockRose as well along the way, as technology also helps you extend the life of fields, so long as it can be done safely in an environmentally sensitive way.
Which makes a lot of sense, because one of my questions was what is a decommissioning security agreement? So you've answered that, and you've actually, we know that operators and so on provided. So it's actually possible one day that you may have too much cash in decommissioning, in your decommissioning account, as it were.
Well, actually, in the UK, we've got net returns from our DSAs this year.
Yeah.
So the amount of money that we're going to be posting as of 1/1/19 will be less than we were posting 1/1/18 because decommissioning has been extended.
Yeah.
Same.
Yeah.
So yes.
Yeah.
These are two-way streets. It's not just a one-way street.
So while we're on that sort of subject, do you hedge your oil production? And if so, how much of it and at what prices, and technically, because everyone does it differently. Do you hedge? We've
had our hedges in place. A number of those have rolled off for the moment, so we've only got a limited amount hedged right now. We've hedged in the past up to about 40% of our portfolio, and our hedges were at an average price of $68 a barrel. We're going to be looking to put some more hedges in place. We want to do it in a slightly different mechanism to what we've done previously. by doing it with an offtake agreement, which meant that we needed to wait until we rolled into a new calendar year to be able to do that in the right way. But it's an interesting one, hedging, because a lot of people look at it and say, well, actually, we don't want you to hedge because you're in the industry. We've invested in an oil company because we want the upside. But on the other side, you've got to be prudent. And so I think our hedging will be largely against the cost of the capital projects that we've got out there. So ensure that we've got that money ring-fenced and leave the rest of the production. The other thing you should bear in mind is over 50% of our production is gas, not oil. And gas has not fallen anywhere near as much as oil has. Current prices for Dutch delivered TTF gas is around $24-25 euros a megawatt hour, and that's down from a peak of 27, 28. So it's really not come down anywhere near as much as oil has. So actually, and gas is always a bit of a laggard. And so I think the gas portion of our portfolio provides quite a good hedge in and of itself.
Excellent. Apart from buying yourselves, you're still on the acquisition trail, I would imagine.
I couldn't possibly comment, Matt.
You never would. But you're always on. You're still on the lookout. You're still staying in UKCS and Norway, or not Norway, but
we're staying in the North Sea. Definitely
staying in the North Sea.
Norway, at the moment, there are a lot of costs associated with being represented in Norway. So I don't think it's somewhere you're going to see us jumping to straight away. But obviously, we're very comfortable in the Dutch sector. We're very comfortable in the UK sector, and we continue to review a number of opportunities.
And do those opportunities are they still coming up, or is it fewer and further between? Or?
No, they're not. They're still there. They're still there, and I think the little drop that we've had recently in the oil price has probably sort of provided some opportunities for us as well.
Because you've got, apart from you mentioned people like Conoco and so selling, but you've still got the private equity firms who are in the marketplace. So it's presumably it's quite a good marketplace to be working in.
Yeah, there are a few people round and about, as you say. There's the private equity companies, there's the traders. There are a series of larger packages out there at the moment. It's been talked about quite widely in the press with ConocoPhillips and Chevron and Marathon all looking at their options. But our niche is to be able to operate slightly below the radar, try and get ourselves into bilateral negotiations with people and do things, and help facilitate sorting out people's problems. And we've proved that we can do that, both in processes. The acquisition of Dias was a process, but also bilaterally moving very quickly, like the acquisition of the stake in Aran.
Now, I was sort of half joking when I said, because we talked earlier about the buyback and so on, it's the cheapest stock to buy yourselves. You know as well as I do that there are people who talk about these things. Some of during the process like that goes on. People say, "Have you ever thought of buy back the business yourself, or use one of these big private equity or funds to say, the shares are as cheap as I've ever seen them, and we should do that?" Or are you going to let it stay on the marketplace for?
Never say never. All things are possible. We've seen a much greater recognition of value than through the buyback, etc., than we'd seen previously. It was only 3 months ago we were trading at £3.50, not £6.50. So we're moving in the right direction, but I wouldn't ever rule it out.
It's a market. You've got to.
The company has its own cash resources as well, which can help facilitate that.
Excellent. Well, time flies, and we've gone through our allocated nearly 20 minutes. I always ask at the end, and for no other reason than I'd like people to think about where you would like to see RockRose in 12 to 18 months' time.
I'd like to see a further increase in production, and I'd like to see the market appreciating the value that's within the company, because I think the shareholders who've been supported us on the way through deserve that. And north of 20,000 a day production, hopefully.
Still the target.
Well, I mean, it's gone up, Malcy.
Yeah.
It was 10 to 12, and then it was 15, and now I'd look at over 20. Just continuing to, we're looking at 100 million EBITDA, over 100 million EBITDA this year. Hopefully the same next year. Assuming hydrocarbon prices remain in the current sort of area, that's a good place to be, and that gives us money to invest. We have access to debt if we need it, but right now we don't need it. No. So, we've got a war chest that we can look at acquiring things with, and we will use it.
Excellent, Andrew. Thank you very much for coming to Core Finance.
Good to see you again.
Thanks very much. It's been Malcolm Graham Wood doing today's chairman's interview slot, and my chairman today has been Andrew Austin of RockRose Energy. Thank you very much for watching, and looking forward to seeing you again soon. Bye now.